Hello, everyone. My name is Derek Yee, and we will be speaking with Hui Min Ng today, who is the portfolio manager for Manulife Investment Management's Asia Pacific ex-Japan REITs strategies. I am the client portfolio manager responsible for covering the Asian equity franchise, and it is my pleasure to be here today speaking with Hui Min to provide some insight on the past, the present, and most importantly, the future of Asia REITs. As she has covered Asia REITs effectively since its infancy here in Asia, I believe her insights and her knowledge of the industry is going to be extremely valuable for us here today. Thank you for being with us. Just to start, we're in an environment for lower rates for longer, and as a result, there's going to be an ongoing global search for yield. As REITs continue to gain more attention, can you give us a little bit of background on the markets, where we are today in terms of, let's say, market capitalization versus 10 years ago, and what are the types of REITs that are available?
Yeah. Thanks, Derek, for the kind introduction. If you look at Asia Pacific REITs as an asset class, it has grown by leaps and bounds since the last decade. Total market capitalization of all the listed REITs in this space has grown from an estimated $115 billion in 2010 to $230 billion as of October this year. This phenomenal growth has been driven by a few numerous factors, including firstly, the general re-rating and appreciation in real estate values in Asia. Secondly, the listing and securitization of more real estate assets by existing REITs as well as via new IPOs in the market. Industrial REITs in general has been the forerunner to acquire assets given the strong fundamentals and healthy demand for the asset class. Over the last 12 to 24 months, we have also seen new listings in relatively new jurisdictions like India and Philippines market.
Great. That sounds like it's a growing asset class, not only from the existing names, but also in its reach across the region. As the REITs asset class continues to grow, would you be able to share with us maybe some of the investment or some of the attributes within the REIT asset class that investors might look for? What has performance been, over the past, let's say, 10 years relative to broader market equities?
The key investment attribute for REITs is that it provides investors with a high consistency and predictability of income that is paid year in and year out. If you can refer to the slide that is being flashed up now, since 2009 to year-to-date basis over the past 11 years, Asia Pacific REITs have provided a total return of 14% per annum, of which almost 40% or 5.7% of this return is coming from dividends. This compares to a 11% per annum total return for the broader Asia ex-Japan equity markets, of which only 2.5% is coming from dividends. Currently, the forecasted yield for Asia REITs is estimated to be around 5% handle, compared to a 2% yield for the Asia equities.
Okay, so you bring up a great point where we're talking about the predictability of income. But given what we've seen this year with COVID-19, how has that impacted the REIT asset class?
Derek, the outbreak of COVID-19 has actually very varying impact across all the subsectors in Asia REITs. Across the world, we could say that the worst hit real estate sectors would be the hospitality as well as the retail sectors as a result of borders closures, national lockdowns, and social distancing requirements. If you look at retail REITs, which have a substantial representation across the Asia REITs market, this sector would have the highest exposure to small and middle enterprises or tenants. These are among the worst affected in this pandemic. On the other hand, industrials and specialized real estate assets continue to generate very stable high cash flows, high rental collection rate, and high income visibility, as the acceleration in e-commerce trends have led to a stronger demand in warehousing and logistics facilities. It's important to note that against this economic shock and challenges, the responses from the various Asian governments like Singapore, Australia, and Hong Kong has also been unprecedented to help companies cushion the economic shocks. very strong fiscal stimulus packages, as much as 20% of GDP, was rolled out in markets like Singapore and Australia. This has helped to cushion the economy and support the recovery as these economies exit the lockdowns since the second half of this year.
Okay, great. You mentioned the policy response by governments. Now, I want to maybe dig a little deeper into the REIT level itself. As a result of COVID, and this question is going to come in two parts. My first question is going to be, how have REITs managed or responded, let's say from an operational standpoint? And then secondly, how have they operated or responded from a financial perspective?
The top priority in dealing with the COVID-19 pandemic across the landlords was to ensure the health, safety, and well-being of their customers, their own employees, as well as the people visiting their facilities. Most REITs or landlords have stayed very closely to government guidelines, and also taken very proactive steps that would include like increased cleaning in high touch points, temperature checks at the buildings, touchless sanitizer stations, additional cleaning packages for their tenants, etc. The pandemic has brought about unprecedented economic shocks and impact, and all stakeholders, including shareholders like ourselves, would have to bear some pain in one form or another. If you look at commercially, landlords for commercial assets in Singapore and Australia were actually mandated to provide rental relief or rental holidays for tenants who were badly affected by the loss of income or sales as a result of the national lockdowns. Hong Kong landlords, while there was no mandatory rule set by the government, have also voluntarily helped in terms of rental commissions, waiver of management fees, lease restructuring, all these to help tenants to tide through the very difficult period. Amidst all these challenges, we have seen governments like in Singapore encouraging corporates as well as retail tenants to evolve and revamp their business models to be stronger in the post-COVID environment. This pandemic has actually accelerated a lot of digital marketing efforts by the retail landlords to help their tenants to sell their product online, or even to do food delivery for the F&B tenants. As with more people working from home, these suburban malls have the urgency to ramp up all this offering to capture the highest that are happening in their neighborhoods.
Okay. That's great insight. When we talk about the impact and the dispersion amongst different sectors within the REITs asset class, how have you changed maybe your view, or has the downturn triggered any changes in your view when we talk about subsectors as a result of COVID?
The pronounced volatility in the markets, especially in the first half of 2020 this year, has allowed us to buy into quality REITs, which we deemed them as expensive before COVID-19 happens. So it actually opens up opportunities for us to buy in bargain hunt into quality names, which we believe will rebound strongly as the growth restores going into 2021. For the first half of this year, we have moved more into the industrial warehousing REITs, given their high certainty of rental collection, as well as high income predictability. And into the second half of this year, we have also moved more into the reopening beneficiaries, as well as expected beneficiaries of loosening of social distancing measures in Singapore or even in Hong Kong.
Okay. Well, now that we've covered kind of the past, we've talked about where we are today. I think it'd be helpful for our audience, to give a little insight into the future. Given your broader economic outlook for next year, what do you think the key headwinds and tailwinds are for this asset class?
The low interest rate environment continues to remain a very strong tailwind for the asset class. Cost of borrowings has continued to head lower, and this continues to underpin the healthy demand for trophy real estate assets across all the key gateway cities in Asia. We still see active physical market transactions being done by long-only funds, be it private money or sovereign wealth funds, looking to increase allocations to hard assets like real estate assets, especially in the logistics and warehousing space. Our base case scenario is that key countries like Singapore, Hong Kong, and Australia should not enter into another national lockdowns, given earlier policy learnings as well as experiences. The positive news bites on vaccine successes, as well as the eventual rollout of vaccination across the key markets, will restore confidence in consumer and corporate spending as we move into 2021. Retail landlords in particular should enjoy recovery in cash flows given the low base effect in this year as they were giving out high rental relief and loss of income due to the national lockdowns. Industrial REITs, on the other hand, are still expected to remain very stable in their cash flows, and any inorganic growth will be boosted by the accretive acquisitions that they have started to be actively involved in the last quarter of this year.
Thank you for sharing. And, I want to finish this with, a hot topic that's been going around the investment world, which is ESG. How are we looking at ESG? How are we integrating that into our investment process? How does that impact REITs or even real estate as an asset class?
If I look across the key markets like Singapore, Hong Kong, and Australia, broadly speaking, the most of the big capitalization REITs are actually highly rated by independent agencies on their ESG metrics. They do have a lot of green mark certifications on their assets. They do have tapped in sustainability loans and bonds, and also have high corporate governance scoring. The challenge lies in the smaller cap REITs, which are still not so proactive on the ESG front. We have actually actively engaged all the C-suite management for these smaller REITs, so they are aware of the importance that the investors are looking at ESG, and there are more opportunities as well as more potential for these smaller companies to improve, and they are also actively taking proactive steps to embark on introducing their own ESG roadmaps. These are actually very encouraging signs for us.
Thanks, Hui Min, again for being with us here today and sharing your insights. I believe that everyone has found, I hope that everyone has found that this session on REITs, talking about the past, the present, and where we're going into the future was insightful and helpful. We believe that in today's environment of lower interest rates for longer, we'll continue to be supportive of REITs, and this is going to be driven by the fact that REITs do have a consistent and a predictable stream of income for investors. So today I'd like to thank everyone for attending this session.